All right, hello NAGDA members. My name is Matt Peterson and I'm NAGDA's Executive Director. We're very excited to have you with us today and want to thank you for joining us for our Legislative Update webinar. We have two goals with today's webinar. First, we want to help you understand how current legislation affects public sector plans. This is a big topic right now and covers several different areas. The CARES Act, for obvious reason, is top of mind for many of you, and we will certainly cover that. But we will also spend time talking about the SECURE Act, which it is hard to believe passed just a few short months ago. And also we'll discuss a recent exposure draft issued by the Government Accounting Standards Board, or GASB, that has not received as much attention but could affect the accounting practices of our 457 plan members. Our second goal is to move beyond the legal understanding and talk about implementation of the CARES Act. For those of you that follow our forum chats, you know that there are a lot of questions out there among our plan sponsors about who's doing what when it comes to CARES. We'll go in depth with some up-to-the-minute national numbers to help you understand how plan sponsors and participants are using the different provisions, especially those related to loans and withdrawals. Before I introduce our expert panel, who will guide us through these complex topics, we'd like to take a minute to get a sense of what our plan sponsors who have joined us today have done regarding the CARES Act. On your screen in a moment, you should see a simple poll related to your decisions on implementing the CARES Act. Please only respond to the poll if you're a government member. If you're not, just close the poll window. For our government members, if you're waiting for board or committee approval to implement some aspect of CARES, just select those you intend to implement. And while you're doing that, I'll cover a few housekeeping notes. We are recording this presentation and it will be emailed to all attendees and posted on the website soon after we finish. The slides from today can be found on the webinars page of NAGDA's website. There's also a link in the chat window on your screen. You will be muted for the duration of the webinar, but please submit questions for the speakers throughout the presentation in the Q&A box found in the menu at the bottom of your screen. Your questions will only be visible to me and the speakers, so feel free to send those anytime, and we'll get to as many of them as possible at the end. We also have the chat feature open, which you can use to chat with your fellow attendees during the presentation. Just realize everyone can see those chats. All right, with that, we'll close our poll, and we'll get to the results later in the presentation. For now, I'd like to introduce today's panelists. Joining us today to give a legal overview of the CARES and SECURE Acts is Megan Murphy. Megan is an associate at Morgan, Lewis & Bockius, LLP, and focuses her practice on tax-exempt and governmental employers. Meg, thanks for joining us today.
Thank you.
All right, helping us understand the operations and implementation of the CARES Act is Katie Moore. Katie is an Associate Vice President of Client Services at Nationwide Retirement Services. As part of her role, Katie oversees the team that ensures all plan administration, record keeping, and day-to-day operational activities are completed for governmental plans. So she should have plenty of fascinating insights to share with us today. Welcome, Katie. And our final panelist today is Melanie Walker. Melanie is Senior Vice President at Siegel Consulting in the National Compliance Practice Office. She'll be speaking about the GASB 457 proposal, and she knows our position well as she authored and helped author NAGDA's response letter to both the initial and the most recent exposure drafts of that rule. Melanie, it's great to see you again. Welcome. Right, for those of you who saw our initial communication about this webinar, you may have noticed that our Legislative Affairs Director, Paul Beto, was also slated to join us to talk about NAGDA's current legislative priorities and recent Hill visits. Unfortunately, Paul's unable to make the webinar today, so I'll briefly mention a few key points about NAGDA's efforts before we move on. The NAGDA Executive Board was able to make its annual visit to Capitol Hill this year in March. We showed up to the congressional staff offices on Monday and Tuesday, and by Friday, those offices were closed, and they're still closed. So we got in just in time. We had excellent meetings with several different offices in the House and the Senate and advocated for our priorities, which you can see here. I want to emphasize two of those priorities today. First, you may notice that number one is called National Retirement Security Month rather than National Retirement Security Week. That's not a typo. In response to feedback we received from you, our members, the Executive Board voted to change the campaign from a week to a month to allow all of you more flexibility when you engage with your participants. National Retirement Security Month will be this October, and we'll be sending out much more information about that shortly. Also, I want to point out number 4 there, that our initiative to introduce CITs in 403B plans was adopted in a standalone bipartisan bill this year. We're hoping that's picked up in other legislation in the future, and we're very excited about its chances. For the rest, I'm going to leave that to Paul. We'll make sure to follow up with all of you with a report on our Hill visits and the status of our priorities in future legislation once he's back in action. So with that, let's shift focus to the 2 major pieces of legislation that are on everyone's mind now, the Secure and CARES Acts. Meg, let's start with you. Can you tell us a little bit about these important bills and how they affect public sector plan sponsors?
Absolutely. Thanks, Matt, for organizing this webinar, and all of you for joining. I know there are a lot of changes that are impacting your plans, and I'm going to try to highlight some of the provisions in both the CARES and the Secure Acts. Starting with the CARES Act, I know most of you have now heard about the coronavirus-related distributions. These are optional provisions that allow for qualified retirement plans, including defined contribution 401A and 401K plans, 403B plans, IRAs, and governmental 457B plans, to permit distributions of up to $100,000 to eligible participants who qualify for coronavirus-related distributions. The $100,000 limit is aggregated by plans offered by the employer, and these distributions are only available to the extent permitted and adopted in your plan from January 1st, 2020 through December 31st, 2020. These distributions are exempt from the 10% early distribution penalty and mandatory withholding. Federal income tax can be applied to the distribution over 3 years unless the participant elects otherwise. Repayment of these distributions is permitted during the 3-year period beginning after the distribution date. As I said before, these distributions are only available to eligible participants. To be eligible, an individual must be diagnosed or have a spouse or dependent who is diagnosed with COVID-19 using a CDC-approved test, or experience adverse financial consequences because of an inability to work due to quarantine, furlough, layoff, reduced hours, or loss of childcare, or the closing or reduction of hours of a business owned or operated by an individual impacted with COVID-19. Plan administrators can rely on this individual self-certification that they meet these requirements. There have been some questions as to how these distributions correspond with the FEMA declared disaster area hardship withdrawals that were recently added as a safe harbor provision. If these provisions have been added to your plan, they are limited to hardships that arise in FEMA declared disaster areas, which is limited to the identified geographic areas. They are also limited to the amount needed to satisfy the necessary need. In contrast, the coronavirus-related distributions are available to anyone who can self-certify that they are eligible for such distribution. They are limited to $100,000. They're capped, and but they are not subject to the 10% early withdrawal penalty. And they also include the ability to repay, which is not available for the hardship distributions. There have also been questions about whether these distributions can be added to money purchase pension plans, and they cannot. Money purchase pension plans must offer a distributable event, and this does not create a distributable event in a money purchase pension plan. So while these distributions are must be implemented now because of the time frame, they do not need to be, your plan does not need to be 2024. Moving on to the loan limits that have been expanded and the repayment schedule has been changed. The CARES Act allows a plan to increase their loan limits from the current limit of the lesser of $50,000 and 50% of the vested account balance to the lesser of $100,000 and 100% of a participant's account balance for qualified individuals who meet the requirements to receive a coronavirus-related distribution. This is the same standard that is available, that is applicable under the coronavirus-related distributions, and also a self-certification standard. These loans at this increased amount are only available for loans made within 180 days following the passage of the CARES Act, and that takes us out to September of 2020, pending any changes, of course. The CARES Act also extended the due date for any planned loan repayments otherwise due between the date of enactment and December 31st, 2020 for 1 year. So participants who have loans due who are impacted by COVID-19 may, their loan repayments are pushed out till January of 2021, and loan repayments may be appropriately adjusted to reflect the delay. Interest may also accrue. Moving on to the 2020 suspension for required minimum distributions. This provision allows qualified defined contribution plans, 401A plans, 401K plans, 403B plans, governmental 457B plans to postpone required minimum distributions by 1 year. This applies to required beginning dates that arise in 2020. Required minimum distributions that have been paid in 2020 may be recontributed back into the plan as an indirect rollover if allowed under the plan or rolled into an IRA. There's some reasonable debate as to whether this is a mandatory or optional provision. It is likely to turn on the terms of your plan and how 401A is incorporated into your plan. So you'll have to look to those terms, but most people we think will adopt this provision regardless. So then I will move on to the Secure Act provisions highlights. Again, another required minimum distribution change. As you know, previously qualified plan participants were generally required to begin receiving their distributions by April 1st, following the later of the year in which the participant attained age 70 and a half or terminated employment. The Secure Act extends that age from 70 and a half to age 72. Your plans will have to be updated to reflect this new age. And of course, you can require earlier distributions, you can set that date earlier, but no later than 72. This is effective for any participant reaching age 70 and a half after December 31st, 2019. The next change was also to required minimum distributions, and it applies to distributions made following the death of a participant. Previously designated individual beneficiary could take a distribution from the inherited account over the beneficiary's life expectancy. This applies to 403B plans, 401A plans, and 457B plans. The Secure Act provides that a designated individual beneficiary is required to take a distribution of the entire inherited account within 10 years. There's an exception to this 10-year rule for inherited accounts paid to eligible designated beneficiaries, and those include surviving spouses, children under the age of majority, disabled or chronically ill beneficiaries, or anyone else who is not more than 10 years younger than the participant. These eligible designated beneficiaries can receive distributions over their own life or the life expectancy beginning the year after death of the participant. An exception to this rule is for a child who attains the age of majority, then the 10-year rule will kick in and they will have 10 years for that distribution. Another provision under Secure Act that has been popular was the in-service distribution option for birth or adoption. This provision allows an exception to the prohibition that's generally in place for in-service distributions, that allows a qualified birth or adoption distribution that can be made from a defined contribution 401A plan, a 403B plan, or 457B plan. This is effective for distributions after December 31st, 2019, and a plan can permit penalty-free distributions of up to $5,000 for expenses related to the birth or adoption of a child. The distribution is not subject to the 10% early distribution penalty and is exempt from mandatory withholding. It also can be repaid to the plan. A qualified birth or adoption distribution is defined as a distribution taken within 1 year of a birth or adoption of up to $5,000 in the aggregate across all plans sponsored by the employer, and the child must either be under the age of 18 or physically or mentally incapable of self-support. The adoption cannot be of a child of a participant's spouse. This rule applies to each spouse, so technically a family could get up to $10,000, but the employer is responsible for enforcing the $5,000 limit across the plans that it sponsors. These distributions can later be repaid to the retirement plan, and we are expecting additional guidance from the IRS on this. We expected it sooner maybe, but things have changed and we will continue to expect it, but probably sometime this year that will come out. Lastly, I just want to mention a change to the age of in-service distributions. This was a change that was under the further Consolidated Appropriations Act that the Secure Act was under, but it is not actually a part of the Secure Act. It changes the age of in-service distributions to 59.5 for governmental 457B plans and 401A money purchase plans. So this aligns the in-service distribution age across several plans, which is a welcome change for ease of administration and better alignment amongst the plans. So absent any additional guidance, we think this amendment will need to be adopted in the year in which you plan to be implemented. So that is my summary of highlights. There's a lot there, I understand, but hopefully some of this has cleared up some details for you.
It has. Thanks a lot, Meg. It is a lot of information, but we really appreciate you stepping through it all. It's very helpful. So Katie, as you've seen, plenty to do for the record keepers, I'm sure. Now that CARES has passed, our plan sponsors are wondering how the optional provisions are being implemented and what applies. So can you tell us a little bit about what you've seen nationwide as all of this has gone through?
Absolutely. So to give some context as to what we're seeing in adoption rates from our plan sponsors, as well as trends we're seeing from our participants, I wanted to share with you the approach that Nationwide is taking because I think that context will be very helpful. There's two different approaches out there in the marketplace. There's opt-in, which is where a provider requires that a plan sponsor opt into the CARES Act provisions, and there's opt-out, where providers are having plan sponsors all opted in and they must complete a form to opt out. At Nationwide, we chose the opt-in path. So we're asking all of our plan sponsors to complete a form to opt into the CARES Act provisions that they would like to adopt for their plans. In the review of the industry and the information I've been able to gather, it's about 50-50 in providers out there as to whether they chose opt-in or opt-out. At Nationwide, we chose opt-in because early on we were hearing, as we were in discussions with many of our plan sponsors, that there wasn't a consistency in which provisions they wanted to adopt based on the plan design of their plans and what they thought was appropriate for their plan and their participants. So we chose the opt-in approach. So with that, let's move to the next slide and talk a little bit about what we're seeing. And I think you wanted to share the poll results before I do that.
Sure thing. So if we could get the poll results up. As you can see, it looks like for most of the people who responded, so we had about 47 responses. Many of them chose both. but some didn't use the loan and only did the distribution provision. So is that consistent with what you saw internally, or is that a little anomalous?
It's a bit consistent with what we're seeing internally. So based on what we've seen from an adoption perspective, we've seen 99% of our plans adopt the corona-related distribution provision. So that's been definitely the most popular one that we have seen, with all but just a couple adopting the full limit of 100,000. We have seen a few plan sponsors dial that back a little bit and adopt a lower amount. For the loans provision, we have seen 71% of our plans adopt the loans provision. So a little less than those that adopted the distribution related provision. But when we break that down into whether they adopted both provisions or just adopted the loan provision that allows for repayments, we are seeing that plan sponsors are electing more often to adopt just the repayment provision and not the total 100% vested amount or $100,000 limit. We do have thousands of plans that have a loan program, and we have thousands of plans that don't. And we have seen about 8% of participants asking for loans where plan sponsors have yet to adopt a loan program. So we are working with those plans to adopt the loan program. We did at Nationwide, so we have a bit of a hybrid in our opt-in, opt-out, and there are other providers out there as well. Meg mentioned there's some differings of opinion as to whether the RMD provision is mandatory or not. At Nationwide, we are waiving the RMD distribution for all of those first timers and those one-time RMD payments that we make. For those participants that are in periodic distribution, where we know part of it is for RMD and part is for ongoing periodic payments, we have chosen to let those continue. So that was our approach to RMDs. What we're seeing from a participant perspective, we are seeing the provision that is requested the most is the distribution provision, which is probably no surprise to anyone. We have had over the few weeks almost 2,000 participants elect to take a corona-related distribution, with the average of that being about $18,000 in that space. For the loan provision, very, very low adoption of that, which kind of corresponds to the lower adoption of plans of the loan provision. Well, we have only 50 participants who have opted to take a corona-related loan. And those loans are the average of about $43,000. I think that's in correlation with the average account balances that we see for our participants. We've not yet had one utilize the $100,000 limit, but have utilized the 100% of their vested account balance. So we're seeing that. Similar to what many of the other providers are doing, we're waiving all fees for those distributions related to the coronavirus, as well as for loans. So we see that going on as well. And then another sad note is we are beginning to see our first beneficiary claims related to COVID-19. So those are starting to come through as well. Overall, our call center activity, very surprising, and I'm going to get to some statistics here in a few minutes related to the market, but our call volumes have remained flat to a little lower than they normally are at this time of year. We're just wrapping up our statement period, and our call volumes actually were lower during that time period than they normally are. However, with that being said, as you can imagine, we do have an increased amount of calls related to the CARES Act, most of those being around the distribution provision. And then we also have participants calling in. This is our second most popular call around RMD and wanting to delay their RMDs and ensuring that we do so. Overall, we have over these past few weeks over 6,000 participants that have called in regards to the CARES Act and wanting information on all of that. As far as our distributions go as well, I said CARES Act distributions are up, but overall our distribution requests are lower than they have been, which is a little bit surprising to us. Some other trends that I wanted to share with you overall, with the way that the market was in March, as you can imagine, we saw increased call volumes in March like we haven't seen in some time. As a matter of fact, we had over a 300% increase in our call volumes in March, which we were really seeing our participants engaging in their retirement plans, asking questions, most of them being around their investments, and you could see how anxious they were. 23% of our entire participant base has called in within the first quarter, which is a very high percentage, which again goes back to how engaged participants are anxious about their retirement plan accounts now. We did see an increased amount of exchanges that occurred during that time period too. We always have exchange activity around that time period, but nearly 11% of participants entered or asked our call center representatives to exchange money within their investments. And we did see a nearly 4% increase in the exchanges, both in and out, interestingly enough, of our fixed account options. So it gives you a little bit of additional context there. There are more males exchanging than females. As a matter of fact, 2% higher, which being someone in operations, I'm kind of an operations geek and love data, so that was an interesting fact to me. Also, we are seeing that the participant base between the ages of 51 and 60 made the most exchanges, followed by the base of 61 to 70. So that tells you that those that are 50 plus are more anxious and making more exchanges in that environment. We also saw that compared to the 2 months prior this year and 1 year prior, that our participants are stopping their contributions at this point in time as well. And we have seen that activity double from March of 2019 to this March. And we expect that we will likely see that increase as things continue and unemployment claims come through and things like that. Other statistics that I'd like to share is where we have provider transitions that are in flight. Many of those have opted to either delay or stop altogether. So that is just a small trend, but one that we are seeing. Along with that trend, for plans that are have fund changes or mapping that are in flight, we have seen a delay in those and believe that that's due to the market and all that is going on. So adoption rates for plans and for participants is slow out of the gate. We are seeing it trend up just slightly, but we aren't seeing big spikes right now. I imagine it's because some plans have not elected yet what they're going to be doing with their provisions. I will tell you though that the participants that are calling in and asking where we have yet to receive a plan election, there are only 109 participants out of our 200 out of our 2 million plus where we don't have a plan who has made an election. So even that is very low. So right now, adoption very low. We expect to see that increase, but it's kind of slow and steady right now.
Yeah, surprising, but it sounds like an evolving situation, which we'll talk about a little bit later. All right, well, thank you very much, Katie. It's tremendous amount of information and very interesting insights, and I appreciate the updates. So we do have a few questions coming in, but we'll get those at the end. For now, before we do, Melanie, let's turn to our GASB 457 proposal. So this is something that you're very familiar with, you've helped us out with. Can you briefly explain what was proposed and what our response was?
Yes, Matt, thank you. Hello to our attendees out there. I'm going to start with a qualifier because I'm an attorney and that's what attorneys do. I'm going to attempt to describe what the GASB Exposure Draft rules and GASB's or NAGDA's response to it based, in a way that it can be helpful to our plan sponsors and the industry members that that help them. And so I do not have an accounting background. So I apologize in advance if I butcher concepts and terms in that way. So that's why let's start with a little bit of background. What is GASB? It stands for the Governmental Accounting Standards Board. Its official purpose is to establish standards for governmental accounting and financial reporting. You may be familiar with GASB rules from your defined benefit plans. Accounting standards for those plans ensure that certain types of actuarial evaluations are made and that in certain valuation information is reported, for example, on a CAFR. You may also be familiar with the GASB rules for OPEB plans. Those are retirement plans other than pension plans. And that's generally retiree health plans. Several years ago, they implemented new rules for OPEB plans, and that caused a lot of change in how retiree health plans in the public sector operated and funded and all kinds of things. So that gives you a little bit of context of what the new exposure draft rules may mean for 457 plans if implemented as is. So how does GASB affect public sector defined contribution plans? Well, until recently, there were really no real GASB rules that applied to 457 plans. And in January of 2017, they issued a Statement 84 called Fiduciary Activities. And those may apply to public sector DC plans if they're defined as a pension plan. So you'll see as we go through this, the information why that might be important for 457 plans. And then in June of last year, GASB issued an exposure draft on 457 plans. And the main purpose of that was to impose reporting requirements on 457 plans that meet the definition of a pension plan. So what were the key requirements for 457 plans? Well, let's start with the easy one. There was a slight change in how all governmental 457 plans have to report their investment valuations. They now have to follow all of the rules in statement number 67 with respect to timing and what's in the valuation. Prior to this, statement 32 allowed plans to just use the most recent investment valuation report from their record keeper, regardless of what that date was. So this is a slight change. I don't think it's going to be a big change for 457 plans. But the big change is that the exposure draft stated that 457 plans that meet the definition of a pension plan will be subject to all the accounting and financial reporting requirements of a pension plan. And in this draft, they defined a pension plan as any 457 plan that provided employer contributions during active service. And if your plan meets that definition of a pension plan, you must follow the statement 67 rules for reporting financial data for your plan. So how did NAGDCA respond to that? Well, the board sent a letter to GASB and during the comment period, and they made several key points. And I think the first one is the big one in that NAGDCA attempted to explain to GASB that there are really no employer contributions in a 457B plan, because even if the employer is putting money into the plan, it's considered wages that are subject to FICA, and they count against the total deferral maximum amount that can be put into the plan. So they're treated like employee contributions. And for that reason, 457 plans may not separately account for employer contributions. And it would be difficult for them to comply with new rules that made them do something different because they had employer contributions in the past or had some in their plan that they did not account for separately. So that was the big one. And then there was some language in the exposure draft that talked about a 457 plan could also be a pension plan if the employer had risk for investment gains and losses. And we pointed out that that generally does not apply, that the vast majority of 457B plans are participant directed and investments, and so the employer has no risk in this area. There are a few FICA alternative plans that are 457B plans that may have that element, but that's a very small part of 457 plans. And finally, we iterated that if the new GASB rules were going to apply to 457 plans that were defined as pension plans, that we would need guidance on how to do that, because they're really written for defined benefit plans. So how they would apply for a 457 plan is a bit unclear. There was also a follow-up call with GASB by members of the NAGDA board and the NAGDA legislative committee, to share our thoughts. And it was my impression during that call that they understood the points that we were making. Let's talk about, there was a revised version of this exposure draft that came out in March of this year. And one of the main things it did was it sort of made it easier for defined contribution plans that may be defined as a pension plan to they would not be subject to statement number 84. Because under statement 84, if you have any sort of pension plan, whether it's defined contribution or defined benefit, and the governmental entity controls that plan using standards that they called financially accountable or financial burden to the government entity, then they have to report that plan as a fiduciary activity and had specific rules for that. So in the exposure draft, they really kind of shut the door on 84 applying to 457 plans unless very specific circumstances apply. And then the important thing, I guess, in a negative, is that they did not change the fact that a 457 plan that has employer contributions does meet the definition of a pension plan. That's still in the most recent exposure draft. And then GASB removed some specific examples on, when employer contributions would make a 457 plan a pension plan, which we thought were helpful and we did not want them to remove. For example, what happens if the employer used to make employer contributions but does not any longer? What if those employer contributions are discretionary? What if only a small number of employers in a large multiple employer plan have employers that make contributions? Things like that. So NAGDA again responded to GASB's new exposure draft during the comment period, and that was just in this month, and reiterated our key points, specifically that we don't believe that 457 plans even have employer contributions. But if they're going to impose these rules on 457 plans, we need a very clear definition of when a 457 plan is a pension plan. And we ask that if there were employer contributions in the past, but there are none currently, that that the statement provide that this type of 457 plan is not a pension plan. And again, we ask for some specific guidance on how to impose the accounting and financial reporting rules that are in the statement on a defined contribution plan, when really those existing rules are for defined benefit plans. So that is where we're at right now. In the most recent exposure draft, it is proposed to be effective for fiscal years that begin after June 15th of 2021. So that for most people, that would be, that could be July 1st fiscal year. And then you would have to begin reporting in 2022. So it's not that far off. And if the exposure draft was adopted as is, then plans, 457 plans that have employer contributions would be considered a pension plan and would have to figure out how to account for and report the plan in accordance with Statement 67. So that's quick summary.
Well, thank you, Melanie. And it's a very technical issue, but one that is very important to many of our members. We appreciate you and all the work that you've done. Obviously, this is an evolving situation. It's something that is still active and is still being deliberated. So we'll continue to update our members. We wanted to get this out there so that all of you are aware of it right now and can start to think about it and address it with your service providers. So with that, we have some time for questions, and a few of them, we have a couple of easy ones. Could you put up the survey results again? I think I moved through that one maybe a little too quickly. So Carly, if you don't mind putting that one back up on the screen. It was about 2/3 who adopted both provisions, and then about 1/3 chose not to go with the loans. So we'll leave that up there for you for a little bit. As we do that, Meg, this one's probably for you. A good question here. How is the IRS notified that the participant intends to spread the tax consequences of a CRD out over 3 years? How would that, the logistics of that go? You pay it back over 3 years and the tax consequences are supposed to be spread out. who would notify the IRS that that was the intention of the participant?
So the provision to pay back is not required. So that can be done as the participant chooses. If the participant chooses to spread the tax consequences out over the 3 years, the provider would report it as, even though the distribution was received, I think the reporting would be noted over, the distribution would be noted as a distribution over 3 years. So again, we're looking for more guidance, especially on these repayment issues from the IRS as they develop more guidance, I guess. But hopefully there'll be some more clarity on that specifically.
Okay. And I know you had mentioned that with the adoption provision. Is there any timeline on that, or is that still just kind of
Not that we've
wide
heard.
open at the moment?
Yeah.
Okay.
Hopefully this year, as it's an available provision this year. So we're hoping to hear something this year.
Okay. Melanie, I don't know if you have an answer for this one, but I think it's an important point. With what you discussed on the GASB, and this was something that we discussed internally as a concern with the GASB regulation, would it discourage a match? Is that something that could be a potential side effect in a 457 plan if that was one of the criteria? Oh, you're on mute right now. Sorry.
Well, yeah, I think you have to look at it from two sides. If you assume that the GASB does follow what we ask them to, and that they don't consider a plan that used to have employer contributions a pension plan, as long as they don't have them currently, as when those rules go into effect, then you might want to consider not putting your match in the 457 plan, to put it in a 403B or 401A plan. But we don't know if we're going to get that, so that may not help you. It's my understanding if you currently have a match that's going into a 401A plan, then GASB would not treat that match as making the 457 plan a pension plan. That's my understanding of the rules right now. So
yeah, complicated, but we'll follow up with that one, and we have a lot of questions for GASB on this, so we'll continue to engage with them. Katie, this one might be for you. How are plan administrators implementing the self-certification part of the CARES Act? And you're on mute. You're actually, I think you just muted yourself. There you go.
There we go. Okay, so what we're doing at Nationwide, and this is what I've seen in the industry too, is we created a self-certification form. So for every distribution or loan that comes in, we're requiring that self-certification form to come in with that request. And that's how we are certifying that it's really a corona-related distribution.
Okay. One probably for Meg. If a participant, just to clarify, if a participant pays back the hardship within the 3-year limit, is the distribution not taxable?
So the distribution is going to be taxable when it's made, or that portion that the participant elects in that 1 year, 2nd year, 3rd year, and the tax will have to be recouped. So these are going to be it's going to be for the individual, the participant, to note on their tax filings. It's going to be taxed, and then hopefully the tax will be refunded.
Okay. All right. Melanie, for the GASB rule, and I'm not sure we discussed this one, are 457s, did you get a sense that from any of the conversations we had, I don't remember this coming up, but the intent was to cover 457 plans if the employer had opted out of Social Security? I don't remember that being anything that I had heard, but it kind of makes sense when it's a good question.
I think that question's getting around if your 457 plan is your FICA alternative plan. In my view, based on the rules that they have currently in the exposure draft, if you have a 457 plan that's your FICA alternative plan, if you have only employee contributions going there, even if they're mandatory, then that would not mean it's a pension plan. if you have employer contributions going into that FICA alternative plan, the current rules would determine that as a pension plan. Also, if you have a FICA alternative plan where there's only employee contributions, but the employer is paying an interest rate rather than participant directed investment results, that may also make it a pension plan because the employer is assuming risk and providing a form of retirement income and replacing Social Security in that manner.
Okay, yeah, that's a good point. Okay, so that looks like it's covered most of our questions. We have a few minutes left. If anybody has any other questions they want to send in, please do. But as we get towards the end, before we go, I want to mention one important initiative that we're working on at NAGDCA that's related to a lot of the data that Katie presented today. We believe that this crisis will have a different impact on public sector employees than it does on private sector employees. And you talked about that a little bit, Katie, when you were discussing how you expected it to kind of change over time as budgets kick in and maybe some furloughs later on or layoffs. The purpose of our partnership with EBRI, what we're calling the Public Retirement Research Lab, which I've spoken on many times, hopefully you're aware of it by now, is to tease out some of those differences by providing data and research purely focused on public sector plans like all of yours. With that in mind, we're currently working with our record keepers, including Nationwide and many others, to compile comparative data to show a national picture of those differences with relation to this crisis, much like Katie presented today, but across multiple record keepers and over time. So Katie, just kind of a question to lead in on that. You'd said that you're expecting, Nationwide's kind of expecting to see some change later on. Is it in line with that? Maybe that as budget cycles turn over, that's really where some of the impact and the corona-related need will show up?
Well, that's what we believe. We hope not, but that's what we believe that we'll see as this continues to extend out, and some states are returning and others are not. So it could be more states are affected differently than some others. But yes, we believe that we could begin seeing. We've already seen in some areas where there have been furloughs that have started. So we believe if there are more of those, that we're going to see an increase.
Okay. So we did get one last question in here. And probably for Katie as well, what's your experience as to who is approving the distributions, the city or the provider, as you've seen them come through?
So here's what we're doing at Nationwide. We have arrangements with plans where we do the approval on their behalf. And so we'll do the same here for these corona-related distributions, utilizing and ensuring that we have the self-certification form. We will work in partnership with our plans where we have the relationship where they approve those. We have fewer of those plans, but we do have some that like to see those distributions come through. So we will work in partnership with them, how we have our arrangement today.
Okay. All right. And we did have one more come through for Melanie. This one could go hard to say how many different, and I think this was part of our issue with the GASB rule, was that there wasn't a lot of specificity to it, but a request for you to address some of the other possible drivers in the GASB change that would cause 457 to be viewed as a pension. I think that was kind of the point of our response to it, was that it was a little bit unclear. I don't know if there were any others that came to mind for you that would specifically. No,
I mean, they did not kind of drill down on specifically when employer contributions would make it a pension plan. Is it ever even a tiny amount? Is it, we were asked for that clarification on, specifically when employer contributions is a match okay? And then also the element of, if the employer is assuming some element of risk in providing benefits, then they consider that a pension plan, regardless of if it's the form of it, 457 or 401k or defined benefit or whatever. So
yeah. So again, we'll continue to monitor the situation, and we'll continue to be engaged with them. We talk to them often about it, and we will continue to after this, and as the rule continues to develop. And we'll obviously be in touch with all of you as members and be sending out communication to update you on the status of that. And if we hear any more or get any more specifics, you'll know them right away. So that pretty much wraps it up, and we'll wait to see if there are any more questions that come through. But I do want to reiterate that we'll be working to compile some data on how coronavirus-related provisions are being used over time. We do think that over time, it'll be a really interesting picture to see. It'll be very different from the private sector data. And so we're working to compile that right now. We'd like to get the 401k data out of the way to not muddy the waters and be able to present you with information that's specific just for the public sector. And we'll plan on having the first part of that information out in the next few weeks, and then we'll follow up on it throughout the year. One more for you, Katie, that's related to, and I think is on a lot of people's minds when it comes to all of these distributions and loans. Our plan sponsors talk all the time about leakage. So there's a concern of leakage, that money's going to be going out of plans that maybe isn't desperate. There's obviously some situations out there that justify it. How are your plan sponsors reacting to that, and what precautions are they taking, or what are the conversations that you're having at Nationwide about that very important topic?
So two fronts. We are hearing from our plans that they're very concerned with leakage, and that's why we see the differences in not adopting both loans and the corona-related distribution provisions. I'm not wanting to open that up, so we've seen some of that. Also, it's our approach at Nationwide to educate our participants on what all their options are, not just what the current one is in front of them, and what might be best for them in light of what they're facing in their situation. So that our approach is to educate on what all options are, and then have them make the best decision for them moving forward.
Yeah, and something we advocate for very heavily at NAGDA is to make sure you're engaged with those participants. It's a tough job, and you guys are doing fantastic work. All right, so with that, it looks like we are out of questions, and so we'll end a few minutes early here. I do want to leave a last couple of notes for NAGDA and our partnership with eBRI. We will be releasing our first research paper soon, and a related webinar later next month. And that will be looking into tenure differences between the public and private sector, and how demographics are shifting over time in the public sector. So it should be some really interesting information, very specific to what all of you are dealing with, and very relevant to all of these issues. Much more will follow. We're very excited to begin to offer you a national understanding of what's going on with public sector issues as that partnership develops over time. I want to thank all of our panelists for coming today. It's been a tremendous pleasure to have all of you on with us. You've done a fantastic job. It's very enlightening stuff, very difficult information. We covered a lot today, so hopefully if you missed something, or if there's more that you need, please let us know, or you can check out the recording on the website. So thank you all for being with us today. I appreciate your time. Katie, Melanie, and Megan, it was really great to see you again. Thank you to all of you for joining us, NAGDA members. We'll send out the survey following this about our presentation today. Please take the time to fill it out. We do look at those and take them very seriously. Let us know how we're doing. And with that, stay safe out there. Have a great rest of the week. Thanks for joining us.